Firstly, welcome and thank you. Thank you to Capital Circuit for organizing and inviting me. And what I'd like to do is perhaps go through some of the common things that I have seen when it comes to financial education, and from what I have learned from giving all the gyan, that I have been giving over the last few years. So my name is Deepak Shenoy. I'm a founder and CEO at Capital Mind. We are a SEBI-registered portfolio manager. We manage around 800 crores in Indian equity and debt markets, and a lot of content that we've written over the last 10 or 15 years has largely stemmed from learning from the markets themselves. I've only recently got a formal degree in finance, but most of my education from this has kind of been in the school of hard knocks, if you may. So let me just go take you through a little bit of what I have learned. So some of the first thing that I learned, at least after a lot of getting beaten up, was that a lot of the financial industry, and I'm part of this financial industry, so I take part of the blame for this as well, is that we love to put lipstick on pigs. And sometimes it's unintentional, sometimes it's very intentional. And the idea here is that the buyer needs to be aware and therefore only select the product that he wants. But largely something that is not very good for you, but it is good for the service provider, will be sold as if it is really, really good for you. And it is now to you to determine whether the lipstick is on a pig or is on something more, interesting. So I'll just take you through some of the thought process around this. One of the things that I do have learned, and perhaps this is an example, is someone comes with a financial product to you and says, you invest 80,000 rupees for 12 years. And then after year 14, you're going to get back 100,000 rupees for like 24 years more after that. And then we'll give you back like 10 lakh rupees. And you're thinking, this is fantastic. This is like my money comes back within X. And then, that you're thinking that this is a great product because it's positioned or presented to you in a way that sounds very interesting. What should have been told to you perhaps, and eventually this is going to be regulation, is that the actual return you're getting is 6.09%. It's actually a much smaller number than you might think. It is not a 50 or 60 or 70 times return that you're trying to get. Or in fact, many times the problem is we don't see how a certain return pattern corresponds to an interest rate. Now, if I said 6%, you might say 6% still sounds good. Well, the government bonds, which are long-term today, and perhaps today is not a great example, but still a 20-year or a 25-year bond today is trading at 7.7 or 7.8% when this product was being sold. In fact, it's currently also probably being sold with even lower returns than this. You're seeing long-term government bonds give substantially higher returns, and you can get much better alternatives, except those companies will tell you 7.5%. They won't present it like this. The way it's presented is a very different part of this architecture, and you'll see that much of what is presented to you in the industry is sometimes a lipstick on pigs. This applies in a lot of cases. If you like, for instance, you're investing in stocks, a sell side report from a merchant banker who's selling an IPO, which will always highlight the good things about the IPO. So it's like, this is a great company. It's not yet profitable, but it will be. There are a few things about it that you should be aware of. And here's the risk sector, and the risk section is peppered in a lot of very, very complex text because they don't want to see the real risk. They'll write it in a way that's legal, but it is up to you to kind of sift through and find out what the real risk is. There was a company that was a holiday timeshare company. It's listed, and once you went through the fine print, it took a lot of work to get through the fine print. Suddenly you found out that this particular company gives 1 week of holidays free per member per year. So technically, one room that they own can satisfy 52 members. because they, assuming everybody is distributed, but then people have kids, they all want the room at the same time. No, but even at the most optimal, a maximum of 52 members per room, can you ever satisfy? For the members that this particular company had, if it had 100,000 members, it did not have 52 lakh or 5.2 million rooms. It did not have that. It had roughly only 30% or 40% of it. So what happened really was that the company is trading below its IPO price today, more than 15 years later. It did have its ups and downs, but that ratio improved only marginally and slightly ever since. So it's been if you went through the IPO documentation, the name was famous, and there was a famous family name behind it as well. But unfortunately, the business economics don't work quite as well when you have a bunch of really unhappy customers, simply because you don't have the capacity to be able to satisfy the demand that you created by and pushing things around. So I think one of the things that happens, and for a person, not from a investment point of view, if you're a person buying into this timeshare, they'll tell you, you pay 5 lakh rupees and you get a holiday free every year for the next 25 years. And you're thinking, this is great, this is fantastic, one holiday will cost me X and so much. But they don't tell you that every year you have to pay some 25,000 rupees as something. And then after 25 years, you don't get your 5 lakh rupees back, it's gone. And then if you're looking at a family of 2 to 4, your holiday expenses in terms of room rent, which is all they give you, is probably of the order of anywhere for a week maximum, about maybe 50 or 60,000 rupees for the same standard of room in any other place per year. But the point is, you're going to also pay 30,000 rupees in this, and then the amenities in this particular place are expensive. So if you go eat food, it's expensive. It's probably substantially more expensive than if you went to an equivalent hotel and bought a meals plan together with it. A lot of the activities in this place are expensive. So it adds up. So once you go into the finer print, you suddenly find out this 5 lakh or 6 lakh or 7 lakh investment is actually not a great investment. It's probably better to go to the same timeshares website, book as a non-member every year, get a holiday whenever you want, wherever you want, because it's out there and available to you and you can decide when. And that freedom comes at a lower cost than going in for the membership itself. So sometimes what it seems is not what it is. And that's a lesson I've learned, because most of the wisdom that comes in finance comes from getting beaten up from something that you've bought. And it's not shameful to do so, because sometimes it's very difficult, even for me, to discover what the risks in a product are. It would be very difficult for a layman, even if they're financially well trained, to figure out what the chinks in the armor are. So I'll take that as one part, and let's go to where the next thing is. Something that I've discovered, that these laws of large numbers means that we cannot really decipher how complex or how weird compound interest is. And compound interest is interesting. And I've written this in the book. I wrote a book called Money Wise. And one of the things that I wrote was that, if you started off with a certain number 20 years back and you got a 20% compounded return, what would it be? Now you could fish your calculators out and let us say you started 1 lakh rupees 20 years back and got 20% return. It doesn't sound intuitive that today that number would be in multiples and of crores today, simply because the 20% number sounds like 1 lakh becomes 1 lakh 20, 1 lakh 20 becomes 1 lakh 40. Yes, for the first 2 or 3 years, but things change very dramatically afterwards. Now here's where it's also interesting. If you understand it, you'll earn it, because you'll be able to stick around for longer, and that longer makes a difference. If you don't, you'll end up taking loans, and people who take loans end up paying compound interest, and they don't realize it until they realize that the amount they've paid is significantly greater than the amount they've earned on their investments, which did not compound, if you may. And let me show you a quick example of this. One of the things that happens is you have a chessboard, Now, there was this old story of a person who said, went to a king. The king said, thank you for visiting me. Would you like to have a gift from me? He said, well, I'll ask you for a small gift. Will you be able to give it to me? But I don't know if you will. So the king says, well, I have all the wheat in the world. I have all the rice in the world. You tell me how much you want. And he said, well, on a chessboard, if I were to place 1 grain of wheat on the first square, and then 2 grains on the second square, 4 grains on the third, and so on. Well, the king's like, this guy wants a few grains of wheat. What's the big deal? Why don't we just do this? And they said, well, yeah, fine. I mean, that doesn't sound like a lot, but are you sure that's enough for you? He said, well, it's going to be enough for me. Why don't we run through this? So if you run through the first row, the first 8 squares, you end up with only 128 grains at the last, the last 1, 2, 4, 8, like that. It becomes 128 in the last, after the first row. That's the last row. That's the last, cell. And then the next one suddenly becomes, after 2 rows, you're at 32,000. Now you're thinking 32,000 grains of wheat. That's not much. The third row, you're at 84 lakh, 8.4 million grains of wheat. Now, that's also possible because a king has a lot of wheat. It's not a huge amount to give 84 lakh grains of wheat. It's not a huge amount, right? The fourth row, at the end of it, there are 214 crores, 2.1 billion grains of wheat. Now that's talking something, because this is probably a granary. In size of things. Then it becomes 550 billion. Then it becomes 140 trillion. So that's each row. And we've only reached 6 rows so far. 140 trillion grains of wheat. By the end, not measured in numbers, but in metric tons, that is the number of metric tons. I don't even know what those numbers are called, because they're a lot, and I don't think the world has enough wheat to pay for this. The point about this is compounding is insane at greater time frames, and we can't gauge it. We can't imagine. When somebody says we'll get to a $5 trillion economy when you're a $1 trillion economy, you're thinking, this is crazy. There's no way you can get to a $5 trillion economy, until you realize it's about 15 years away. And in those 15 years, the growth rate from 1 to 5 may not be so huge that you imagine to grow. If you double every 7 years, the 1 becomes 2, the 2 becomes 4. And if you double every 7 years, you're growing at 10%. An economy grows at roughly the real growth rate, which is about 5-6% for India, and inflation, which is about 5 or 6% for India. So you're talking 12%. In 12% on a period of 15 years, 1 trillion will become 5 trillion, assuming the dollar equivalent is roughly maintained, just by the sheer nature of it. But the statement was made when India was already $2 trillion, so it's not unachievable. But the point is, we think of these large numbers in those ways. So somebody tells you your retirement corpus that you need is 14 crore rupees, and you're thinking, my God, how am I going to get to 14 crores? If you're 30, the amount of money it takes you to get from even say 1 or 2 lakhs, which you start off with, all the way to 14 crores, may be remarkably small. And it's complex, but that's the idea of compound interest, that it isn't obviously intuitive to everybody. One of the things that I like to say here, markets, they tend to grow when you sleep. They don't necessarily give you this smooth ride upwards, but it's actually quite fascinating that when you're sleeping, when you're not looking, is when the market seems to grow. There are 2 kinds of lessons over here, and I'll give you my own story. Is a long time ago, when my father passed away, I was 97. There were a bunch of stocks that he had left for us, and those stocks were something that we didn't know what to do about. It was really, really long back, and we did not know what to do with them, we didn't want to do anything with them, so we kind of left them there. And while they were about 30, 40, they were paper certificates. Then the demat came about. Then we went and dematted all these stocks. Some of them still remained as paper because those companies had died. And, come what you may, about 10 or 15 years pass. And in those 10 or 15 years, it turns out that just because we hadn't sold, now some stocks went to zero, it doesn't matter. Only about 7 or 8 stocks survived. And those 7 or 8 stocks gave a 40x return in 15 years, and 15, 16 years since after that, after which we did our first set of transactions that involved rebalancing some of those shares. But the interesting thing was, it wasn't that we chose great stocks. I think the choice of stocks was good as a hindsight. A lot of stocks went bust as well. So some of them were great stocks, some of them were great in the beginning and then kind of died towards the end. But the point was that the money was made in the sleeping, not in the acting and changing and buying this, selling this and buying that. And how did we miss Bajaj Finance? And it doesn't matter. In the end, your stocks will grow when you sleep. Even a Bajaj Finance, if you're tracking it every day, you would have sold at 5x or 10x. You wouldn't have waited till 100x for the longest time. So it takes a lot of temperament to actually sleep through a crazy time. And one of the times is today. It feels like you should sell everything, go away, and come back when the markets are brighter. But possibly the best thing to do is what this baby is doing right now, which is to sleep soundly if you can. Not that everybody can. It's just a way to say things. But I think also sleeping like a baby just means this, right? You sort of sleep with no worries. And this is another reason why you should only invest in the stock market, in the risky part of your business, of your investments, only to the extent that you can sleep soundly at night. And, stocks will grow when you sleep soundly at night. Here's a thing that was more narrower as a time frame. The narrower time frame shows us that if we calculate the amount of moves the Nifty, that is the NSE top 50 stocks, together accumulated into an index, makes from the open of the day to the close of the day. That means it's the intraday move. If I added up only that, what the market does between the open and the close of the day, from up till 2008 or 2009, things were okay. And then there was something called a pre-open auction, which started. And since then, a very interesting, of course, this was the reasoning, but here's what has happened in the last 11 or 12 years. The market has moved at night. If you took the movements from today's close to tomorrow's open, that is the overnight move, and the market is not acting at all. So whatever the market closes at today, if it opens tomorrow morning 10 points higher, that means overnight we made 10 points. If I added up only the overnight moves, the Nifty, most of the Nifty's move has happened. In fact, all of it and more has happened overnight. It's the intraday that has just been cumulatively negative and negative and negative. So it means that more money has been made by overnight moves when the markets didn't have a price, to the time when the markets had a price every second all through. So it's a very interesting proposition because it's happening at the small time frame and it's happening at the large time frame as well. So just that, as I'll leave you with this. Another thing that I've realized is, this is something I wrote in my book as an example. When you're investing for the long term, you're doing this FIRE or whatever it is, FI, financial independence. You're thinking, I'll invest a little bit every month and, it'll grow. So somebody tells you, listen, you invest in the stock market, you'll get 15% a year. Fantastic. Anjan, who's one of the persons here mentioned, invest 10,000 rupees a month every year for 10 years, every month for 10 years into the stock market, gets 15% a year, only 10,000 rupees a month. And he does this consistently, the SIP format all the way, ends up with 27.5 lakh rupees. Okay, so you're thinking, fantastic, 10,000 a month and ends up with 27 lakhs. Do everything by 10 if you think these numbers are too small. So 1 lakh a month becomes 2.75 crores at the end of 10 years at 15% a year. Fantastic, great. Here's the other story. There's a guy named Sumit, and he's investing in a boring bond fund because he's just like, doesn't want great returns or whatever and all that stuff. And of course, 8% a year sounds great over the long term, but that's roughly what the bond markets have given you over the last 10 years, I think, if I were to look at it objectively, I think roughly 7.5 to 8% a year. Even liquid funds gave you a phenomenal return in the early parts of last year. But let's say there's a very boring bond fund, nobody was talking about. He gets only 8% a year. All he does is one thing. He says, "Listen, I know I'm saving every year. No, I'll save 10% more. So 10,000 rupees a month will become 11,000 in next year, and then 12,200 the year after that, and so on and so forth for 10 years. So I only change it once a year. So by the end of 10 years, of course, I'm saving a little more. I'm saving this 20,000 rupees, but my salary is also going up. And, the savings and the costs are going up, but the salary is going up, and then the savings are also going up. So I'm able to make this 10,000 rupees extra, 10% extra per year. All I did was that. And then Sumit, in the end, with only 8% a year, about half of what the equity markets gave, he got it in the bond markets. He ended up with 29.2 lakhs, which is more in absolute terms than the 27 lakh that Ranjan got. You might say, Deepak, but he invested more. But what's the point of that? The point is, if you didn't invest that, you would go spend it on some, Starbucks somewhere. 3 coffees will cost you $1,000. So it's literally that much. But those 3 coffees will not be available for that 2 lakh difference that you're seeing at the end of it. You need 10%, 8% higher. He's getting 8 or 9% more in capital at the end of this term. So just that little bit more can compensate for a substantially lower return that you might make on investments, which means you don't need to have all your investments in the highest return possible kind of scenario. You just have to invest as much as you want to or can, but increase it over time rather than keeping it static. So your process, which says 10,000 rupees a month, should go to 25,000 rupees a month as you grow. And then as perhaps you might become big enough to say it's 1 lakh rupees a month today, but the same percentage of your salary, and your salary might have gone up. And in India, a lot of wages have gone up substantially, especially for people who are perhaps accessing this video as well. I think this is where the secret to financial independence lies, is just a little bit more, right? There's a lot of stories we can talk about, but here's an example of just using math and coming out to the numbers. It's not evident that just putting 10% more every year will result in a substantially higher actual end value, even if I got half the returns of what someone else got. It's like someone coming to me and saying, Deepak, I doubled my money on this stock. This stock is great. How much do you invest? 5,000 rupees. Well, 5,000 rupees double 10,000 rupees. This is not going to change your life, but he's very happy that he got double the return. This is why these IPO things, like, I bought this IPO, it was fully oversubscribed, I got one lot. One lot is like 12 or 15,000 rupees, okay? And the guys on Twitter saying, I bought into this IPO, it doubled on IPO listing is 30,000. This 15,000 is like not a huge amount of money for someone who invests in an IPO and maybe invests in 30 IPOs also. This is still not going to change anybody's life. So I think basically we sometimes look at these percentage returns much more in a way that seems to excite us than we should, in that context. Let me move on. There's another thing that I told you about, which was when we evaluated my father's portfolio about 15 years after he passed away. Only a few stocks survived, and those few stocks gave us enough of a return that the portfolio was 40x, right? So it was very interesting to see why that happened. And I said, okay, does this always happen? Is it only us? Was it? So I took last year in 2021, I did a little bit of an analysis. I do this every 4 or 5 years. I say, listen, for 10 years ago, roughly 10 years ago, let me see what the Nifty was like. And today, if I had bought the Nifty at that time and slept, because I said money is made when you're sleeping, right? If you bought all the 50 stocks in 2010 and you held them till 2021, what would happen? 7 out of the 50, that means nearly 15% of the stocks, 7 out of the 50 fell more than 90%, which means This is contained Reliance Capital, Reliance Infra, Communications, JP Associates. Some of these don't even exist today, like Unitech. But they fell more than 90%. You're thinking, my God, you selected 50 and 7 stocks fell more than 90%. That's insane. But apart from that, the public sector stocks, and some of them have recovered since then, but between minus 15 and minus 90%, they fell in absolute terms. Forget inflation and all that stuff. Just absolute terms, they fell between. So roughly 19 stocks now have given you subpar returns, right? Now, let's look at inflation. If it's 6% a year, that in 11 years, you should roughly double, at that time. But 9 stocks did not even give you inflation level returns. Now, these are stocks. Of course, since then, some of these stocks have gone up, but I was evaluating it in 2021. And those stocks did not give you that much of a return, even in 11 years. Now, 28 of the Nifty stocks didn't give you a great return. Now, Nifty itself give you a 10.7% return. Nifty changes every 6 months. You remove the bad stocks, put new stocks and all that. With doing all that, last year, Nifty had given a 10.7% annualized return for a 10-year period. It's the same right now. It's about 10.5, 11%. Well, Nifty went up and fell down and all that. And yet, 9 stocks gave you less than Nifty return, which is a lot of the cement stocks and the ITC and so on. After that, the stocks that are really good are only 13 stocks. The really good mean they've given you more than 11%, up to 20% 9 stocks, more than 20% 4 stocks. So only 13 stocks have given you returns that people brag about, like 20%, 11%. Only 13 out of 50. This is the top stocks in the country, and yet only 13 stocks. In fact, only 4 stocks have given you that phenomenal return. This means no matter what you do, it's going to be a few things that matter. And this is true for literally everything, philosophically speaking. No matter what you do, you find out that the smallest little thing which you didn't think was a great deal suddenly becomes the moving point of your entire career. I met a stranger on a bus and shook his hand, and 5 years later, this person looks at me and says, "I know you helped me when I was in a bad shape, and that's the one thing that I'll give you this great job," and or whatever. It happens to all of us that whatever plans we make. Sometimes the smallest things, it's only a few things. If you look back at your entire life, it will be only a few things that mattered. But it's the same in the stock market. It's the same, and even perhaps less in the bond market than the stock market. But it does matter that a few things will give you those extraordinary returns, and everything else will give you ordinary returns. And you shouldn't fret about that. So people who want to win everything lose a lot in the markets. Because what they will do is, whenever there's a stock that's winning 30%, another stock that's losing 30%, they will take 30% profit out, then put it into the stock that's losing 30%, thinking that will come back up. But usually a stock that's going 30% will go 50% up. And the one that's down 30% will go another 30% down. So you'll end up losing. Warren Buffett actually once talked to, I think, this guy who wrote his book, Peter Lynch, and asked him if he could use a line that Peter Lynch had written in his book. And the line was, selling your winners and adding more to your losers is like cutting off the flowers, cutting off the roses and watering the weeds. It's true. You're actually doing that when you do this. So if it's only a few things that matter, the things that are doing well, let them grow. Because that is really the story of everything in your life. And you'll see this in a lot of things. The top stocks in the US just seem to get bigger. Why is that? Because the businesses that do really well have the advantage of size, get the advantage of sentiment, and a lot more things happen. Great things happen. Microsoft's been one of the top stocks for the longest time. Of course, some stocks will wither and die. But if you retain a portfolio of companies that you think are great, only some of them will be great, actually. The rest of them will not. So focusing on everything is a bad idea. Coming back to 2 more things I'll talk about. First thing is, people like stocks a lot. Okay, so people do think that stocks have, if I do all this research on a stock, I meet the promoter, I listen to all the conference calls, somehow the stock will give me great returns. It doesn't. It doesn't have to. It won't. It may never give you great returns. But The point is when you buy a stock that it is not expected, it's not going to love you back. It's not just because you've done a lot of research on it doesn't mean that it's the greatest stock in the world. So stop marrying your stocks, because I think having pets or a family is what loves you back, but stocks don't. Okay, so coming to fixed income, and I think one of the things that we've talked about in this, I've heard a lot of presentations here as well, was a lot of people simply start with how much do I get, and that's great for fixed income because you can actually determine how much you can get. But one of the things that happens is people fear volatility, and they think it's the fear of risk. So, for instance, a government bond going up and down, if you don't have a need to withdraw the money right now, you can hold on till maturity, which a lot of people can. And they started off thinking they will hold on to maturity, suddenly see the value of that investment fall because, let's say, interest rates have risen or whatever it is happened in the last 2 months. You find that they get scared and then they walk away from that volatility. The one exception, of course, is European bonds last year, where they were yielding negative returns, which is you actually had to plan to lose money right from the beginning. So you gave a bond $100, it would actually give you back 99 minus 1% interest rate. So you were planning on losing money. But in India, that's not happened. So India, what would happen really is that instead of a bond going from 100 to 150 over time, including the accrued returns, you would go from 100 to 120, come back to 110, and then go, so it would do this little ride. And sometimes you may be below your actual investment as well. And as long as that is there, the volatility fear will always masquerade itself as the fear of risk. Today also, you see the markets are down. There are certain announcements that happen. Everybody reacts in panic and does certain things. The markets are down, but that doesn't mean the markets are done. It's almost always an interesting part. Here's the last part, which is the high returns mask risk in debt, which means if somebody is offering you guaranteed fixed income kind of returns of 14-15%, there's a lot of risk that sits inside. What's safe often is not. That means you think something is safe, but it's not, because the returns actually mask the risk. All right. Last, I'll leave you with this. Don't get suckered. Be like the cat, not like the dog. If you've ever had a cat or a dog, you know that the dog will love you unconditionally. A cat will love you, but will always question that something you do is not in the right spirit, or may not be the best thing for them. The cat is curious, but questioning, cynical in a way. The dog is loving and faithful, and perhaps you should be more like the cat when you're in financial markets than a dog. This is the lessons I've learned in the process of being in financial markets. I hope you liked this presentation. Do get in touch. I'm at capitalmind.in. I'm at Deepak Shenoy on Twitter as well. We'll close the session now. Thank you so much. It has been lovely speaking.